What if I told you there is a mid cap chemical company in India that has spent over 750 crores on projects, including clean fuel, battery, chemicals, and import substitutes, and yet hasn't seen much revenue uplift so far? In a sector where global competition and margin pressures are real, what does this spending actually mean? Welcome to AlphaCall. I'm Radhakrishnan Chonad from Alpha Street, and in this series, we break down Indian earnings calls into insightful narratives looking beyond the headlines. And in today's episode, we are focusing on Balaji Amines and their Q4 FY25 results. We'll ask the questions a research analyst would. What exactly are they building? What's working and what's not? And most importantly, if there is a pattern in how they deliver on their promises. To give you some context, Balaji Amines, headquartered in Solapur, is one of India's largest manufacturers of aliphatic amines and their derivatives. These chemicals are used across pharma, agro, paints, solvents, and several other downstream sectors. Over the past few years, Balaji has tried to move up the value chain, positioning itself beyond just commodity production. They have made big bets on high barrier import substitute products like dimethyl ether, electronic grade DMC, and cyanide derivatives. To their credit, they are one of the few Indian players with indigenous manufacturing technology and REACH certifications, REACH, giving them access to regulated export markets like Europe. But here's the reality check: this isn't yet a high growth story. And over the last 5 years, Balaji's revenue has grown at a modest CAGR of around 8%. And margins have remained volatile, driven by feedstock price swings and exposure to global competition. Now, let's look at the recently reported quarter numbers. And they had their call last week. For the fourth quarter of FY25, Balaji reported revenues of 361 crores, and that's a 12% improvement over the previous quarter. EBITDA, basically earnings before interest, taxes, depreciation, and amortization for the quarter, stood at 68 crores, up 26% quarter on quarter. And the net profit came in at 40 crores. Now, on the face of it, that looks like a clean recovery. But if we zoom out and look at the full year picture, the softness becomes evident. For the full fiscal year, revenue declined by 14%, 14% year on year. And profit after tax dropped 31%. Management attributed this decline to margin pressure, raw material price volatility, and underutilized capacity at several of their plants. Now, these aren't new challenges. Balaji has faced similar headwinds in previous years, especially in product categories like DMF and EDA, where dumping from China continues to skew the market dynamics. Now to the real story: the strategic bets and pipeline. The company's ongoing capex cycle, if you look at it, Balaji has invested about 440 crores into capacity expansion. However, many of those assets are yet to contribute meaningfully to their revenues. The most prominent among them is the DME plant with a capacity of 1 lakh tons per annum. It's been mechanically completed but is still awaiting PESO approval, PESO approval. And once cleared, Balaji plans to blend this with LPG, supported by a BIS notification that allows up to 20% DME blending. In parallel, the company's electronic grade DMC plants has started dispatching trial batches to battery chemical customers. Early feedback is in progress, but full scale commercialization is yet to kick in. Their rooftop solar plant is already operational and should help reduce energy costs across their units. Meanwhile, in their subsidiary, Balaji Specialty Chemicals, greenfield expansion worth 750 crores is underway. This project involves production of hydrogen cyanide, sodium cyanide, EDTA, and other import substitute molecules. Now, the management expects phase one of this project to go live by the end of FY26. And it's also worth noting that back in 24, Balaji had commissioned a large methylamines plant. But that project took several quarters before it started contributing meaningfully to the top line. And that brings us to the key question. How long will this next wave of capex take to show up in their numbers? So net execution risk continues to be the core concern. For FY26, the management has guided for volume growth of around 10 to 12%. So some margin improvement is expected, but that depends heavily on the stability of raw material inputs like methanol and ammonia, which are globally sensitive commodities. In newer segments like battery grade DMC and NMP, customer validation and volume ramp up are still in early stages. In fact, when I looked at their November 2024 earnings call on Alpha Street, the management had acknowledged that takeoff in these products was slower than anticipated. Now, on top of this, several of their new chemical projects are still awaiting environmental or regulatory clearances, including NBPT, which is used in agrochemical applications. So, while the direction of strategy is pretty clear, the timeline to revenue contribution remains uncertain. To sum up, Balaji Amines is a company with deep manufacturing roots and an appetite for specialty chemicals. But as with many capex heavy plays, the question isn't just what they are building, but when those investments begin to deliver. At Alpha Street, we are building a global financial ecosystem, one that connects public companies, investors, analysts, and expert networks to generate AI powered decision grade insight. And this episode is a small part of that larger vision. I'm your host, Radhakrishnan Chonat. Thanks for listening. Do follow AlphaCall to stay updated on India Inc.'s earnings season, decoded with data and context.